Welcome to the Possible Promise podcast. Every Monday and Friday, we go live at 12 p.m. Eastern to break down the complexities of finance and point the way to financial freedom. Today is June 12th, 2020, and I am your host, Brandon Oliveris.
And I'm his wife, Christine.
This is episode 2, Slow and Steady. Welcome everyone to our podcast. We're really glad you could join us. Again, we're live right now, so if you are listening, feel free to ask any questions, to chat, or anything else, so that would be fine. I will be checking the chat. I should probably enable the tab where it is.
That would probably help. Today is a beautiful Friday afternoon here in Pennsylvania.
It is, yeah, and it's been quite the week.
Yes.
so I said on Monday I didn't want to short the market. I really should have shorted the market. It was...
Ooh, he admits mistake.
I'm
kidding.
More timing. I really should have shorted the market. While I'm talking, I'm going to find out. We have a question for later, and I forgot to bring it up.
Oops.
That's okay. I can find it easy enough. So, yeah, I mean, this was just a bloody week.
Especially yesterday, right?
Especially yesterday, yeah.
Really bad?
Yesterday, the S&P fell by like 5.9%. The Dow fell by almost 7%. The Russell 2000 fell by 7.5%. The NASDAQ fell by only about 3.5%. But it was huge. It was the largest intraday drop since March. Now, for those who were investing in March, you remember, like it seemed like every other day we were having 7% drops. We'd hit those circuit breaker points where the market would pause for 15 minutes because there was such a drop.
Oh, did we have those? I didn't know that.
Back in March, yeah, I told you about
March,
it.
yeah. I thought you meant this week.
No, I don't think it quite happened yesterday because it was almost the end of the day by the time it hit 7%. I don't think it quite happened.
Yeah, I misunderstood you.
But it was... I mean, we haven't had days like this since March.
That's what you said yesterday.
Crazy.
And people lost a lot, didn't they?
I heard people who lost... The biggest number I think I heard was someone lost $15,000. People lost, someone lost $6,000. Some people just several $1,000s on all accounts. That's why I want to talk about... Well, actually, I wasn't sure what I was going to talk about at first, but this is a really good time for this. We're talking about, how to deal with big market moves like this, and especially... Sorry, I'm trying to find this message. Especially, how to play it safe on, risk. So you're not too risky. You're not trying to, make a ton all at once or lose a ton all at once. Because that's what so many people are doing, But this week was, I said on Monday, the last, month or so, even 2 months, like I said, the 12% gain in April, 4% gain in May, have been crazy as far as just the market going up and up and up and way too bullish. And I said that on Monday, and yesterday was sort of all that kind of just dropped. To me, it reminded me of if you're in an airplane and you're kind of cruising along at 30,000 feet, and then all of a sudden, the bottom drops out from under you, yeah. And you're just like, okay. So it was just nuts. And, I think the thing is, the economy is opening up. And so a lot of people are happy about that. Obviously, businesses are coming back online, and that's all good. In fact, I was going to mention this Monday and I forgot. We went out to dinner for the first time
on Saturday.
Last Saturday. Oh, that was so nice. It was nice, and it was also a bit weird.
And scary a little, too.
And a little scary, because it was like at half capacity. It was like you couldn't just have a shaker of Parmesan cheese. They had to bring them out in little packets because, you know, obviously with a shaker that's communal, like anyone can touch it and they can have germs, which you wouldn't think about before.
No, you really wouldn't.
Like, it's a good point, right? It's like, oh, that's cool. Like, I'm a germaphobe.
Or at least, like, wipe it down first.
Right.
Like, you know, take a Clorox wipe or bleach or something and wipe it down.
Because, I mean, I'm a germaphobe, so it's like...
Yeah, you're really... I mean, you kind of are, but you're really not.
Yeah, but
because I know people who are, like, really germaphobes. You're just kind of a germaphobe.
Yeah. But it's something I wouldn't have thought about. Like, oh, wow, you know, people are touching these things. And who knows what they're doing with them, you know? Sorry about the voiceover.
I don't mind it. I feel bad because it's going to take you a while.
No, it won't. I know. I have a search term. I know where it is. It's just have to find it. We talked a lot. But, I mean, it was nice to go out, but it also felt like this post-apocalyptic...
It does! I'm waiting for the rapture at any minute. I mean, I say it, you know, candidly, but seriously, it's like, I don't even know.
Yeah, it was, it was bad, but, yeah, I mean, it was weird going out. It was really nice, though. So that's, you know, that's on one hand, and on the other, you know, on Wednesday, there was the much awaited for Fed meeting, and the Fed chairman Jerome Powell came out, and he was very sobering about his comments, and his tone was very somber, you know, and he was just saying, like, okay, we probably won't reach much less than 9 or 10% unemployment by the end of the year. The recovery is going to take a while. Like, things aren't going to be so easy. So people were pricing in a V-shaped recovery, meaning, you know, we have the big drop and then we have a big gain and that's it. And I think that's naive to think that. And he was seeming to agree with that. It's going to take some time. And so on Wednesday you saw a drop. Well, Tuesday even was a drop. Wednesday was a drop. Thursday was just the bottom fell out. And then you have in Texas and in Arizona and California and I think in Florida, cases are kind of on the rise a little bit. So just a lot of kind of scary stuff going on. Today I'll give our indices numbers. Let's see. Today, it's been all over the place today. So it's just kind of a flip of the coin where we are right now.
No news effect?
That's for stock picks.
Oh, that's right.
Yeah.
Sorry, I'm
very
sorry.
So Christine's very excited about sound effects.
You know, I'm also new.
Well, I mean, I'm new too.
Well, you've done podcasts a lot more than I have.
So the S&P is around 3,021. It's up about 20 points, only about 0.66% or 66 basis points. The Dow Jones is up about 225, about almost 1%. NASDAQ is up about 42 points, about 44 basis points. So, and the VIX, I'm going to talk about the VIX today. I added into my little program.
Do you mean like Vicks Vapor Rub?
No, I'm going to tell you what the VIX is.
Oh.
No. Yes, well, that's.
I thought you were talking about
the NASDAQ and the S&P. Oh, by the way, Vicks Vapor Rub. Yep. That's exactly what I meant. I thought it was a stock ticker. Why would I just randomly mention Vicks Vapor Rub?
I don't know.
The VIX. The VIX is at 42.
I'm sure other people had that going through their head.
I will talk about it. It's actually, holy God, it's actually up 3%, over almost 4%. It was down. Well, so yesterday it went up like 50%. I'll talk about it's the volatility index. It was up almost 50% yesterday, 47%. Today, it was down 10 to 15% this morning, and then the market's just been really choppy. It's been nuts, which is killing me. I have a 0-day option in for today, and I thought, oh, it's a no-brainer. It's going to be really easy. And then the market kind of dropped. It's doing okay now, but
of course.
So
just when you think it'll be easy.
So the VIX, I'll talk about this a little bit now, I guess. The VIX is the volatility index, so it's basically a measure of, or a prediction of the next 30 days of volatility for the S&P.
Oh.
So volatility just means basically how much is a stock predicted to move on a daily basis or in a period of time, right? And so this is over the next 30 days. So like volatility of, 42, the volatility is annualized. So it's like an annual up and down 42%. So volatility, like before yesterday, it was down around 28 or so, and then it jumped up to like 40 yesterday. And then today it's kind of up and down. But volatility is a good indicator. It's called the fear index because it goes up. It tends to have an inverse relationship with the S&P. So when the market goes up, volatility tends to go down because, people are obviously, if they're afraid, they're not going to buy stocks, right? If the S&P goes down, then volatility tends to go up. Not all the time, but it tends to happen. So yeah, the VIX is up today. So yeah, I added to my little program of indices. But volatility is useful because it tells you whether for the S&P itself or for a certain stock, kind of how far you can expect something to move in a given time. So like with a volatility of, what I say it was, 42.37 right now, you can basically de-annualize that. What I mean is like you can reduce that down to a certain length of time. So if you want to know, this is just for anyone who's good at math. I'm going to lose a lot of people right now. It's an interesting formula. If you want to know the daily expected move for a stock up or down, you can take that volatility and multiply it by the square root of 1 over 365.
Oh, good to know.
365 because it's the number of days in the year. 1 or however many days, 1 for like 1 day move. But if let's say you want to know in the next month, the next 30 days, then 30 over 365. So like for example, if I enter in that 42.37 times the square root of 1 over 365, you get... Oops, actually, let me try that again. I made a mistake.
Yeah, you didn't type that right.
Okay, I forgot to hit equals. Let's try that again. So about 2.21%.
It said 2.17, I thought.
It says 2.217.
I missed the 2. Sorry.
That's okay. So 2.21%, that's your expected move for the day, and that's really high. Like for the market to move up or down 2.1%. And that's pretty accurate. I mean, let's see, the S&P, its high today was up around 2%. It's still up for the day, so hopefully it doesn't drop 2%. But this is a plus or minus. This is sort of a, if it goes, it can move either direction. So it's really helpful for options. I'll talk about why in a future podcast. But it's really helpful to know volatility because it helps you to know, like, how much can I expect a stock to move on a day-to-day basis. So just a little quick lesson on volatility. You're welcome.
Gosh, okay. But it's good to know that really.
So again, just to kind of, I'll put in the show notes. To summarize, it's the volatility either from the VIX or if you're on a certain stock, you can get it from the option chain. Times or multiplied by the square root of the number of days, or just 1, divided by 365. And that gives you your volatility within a certain time frame. So it's interesting. I like it. I have a little program, of course. What's your normal thing?
Of course you do.
That tells me the expected move if I enter in a stock.
He has a program for everything except maybe cleaning the house.
If only. I have programs for everything. And so, I have a little program that tells me, if I have a certain stock, either the 1 day move or a move within a certain time frame or whatever. So it's useful. I like it. So I think... No, I didn't... Oh, I'm in the wrong...
Did that say morgue? It sounded like it said morgue.
No, because I was searching for something. Okay. I found the question. That's good news.
A new sound effect.
Yeah, in a second. Yeah, just in a second. All right, so I think that's our sign. Let me make sure we don't have any chats or anything. That was me that entered that. I said hello. All right, so we're good there. If you do have questions, feel free to ask. But right now, I do have a question to answer, so we will enter our segment for Ask Possible Promise. That's what I'm calling it.
Oh, awesome. Very original.
Very original. You know what? You come up with a name then. All right, so someone is asking. Let me copy and paste this so I can read it more easily. All right, so someone wants to know what to do with an inheritance. Is it better to invest versus paying off a mortgage? How do you know what the right answer is?
That's a really interesting question.
It is, yeah, and it actually has a pretty good answer, hopefully. Now, of course, anyone has to kind of do their own due diligence. Don't follow my advice just because I'm giving it here. You're responsible for whatever you do. But, so, it's a good question with debt versus investing. And a lot of people ask that question. Should I pay off credit cards versus investing? Should I pay off student loans versus investing? Should I pay off mortgage versus investing? That kind of thing. And so it has a good answer. And it depends on the person. Some people are so anti-debt that they say pay off debt no matter what. I know, what's his name? Dave Ramsey is a lot. I don't like him. No offense to those who do. I think he's too anti-debt. I think that debt can be useful in certain circumstances. So here's the thing. With a mortgage, your interest rate is usually pretty low, right? It's usually under, correct me if I'm wrong, but I think it's usually under like 4%, 3 or 4%.
Like I would know.
True, but...
You said correct me if I'm wrong.
Well, I don't know. In case a fairy pops out of nowhere and says, "You're wrong!" Okay. So, mortgage interest rates are usually pretty low, under 3 or 4%. It's sometimes a lot lower, it just depends. And so, the rule of thumb I go by, first of all, I don't believe in all or nothing. So if someone comes to me and says, I have credit card debt and I want to invest as well, my answer will tend to be do both, because you can't start investing too early. Right? Whether you're investing for retirement or for income generation or, wealth building or whatever it might be, or, future goals, buying a house. Well, I guess if you have a mortgage, you already bought a house. But, whatever it may be you're investing for, you can't start too early. Now, how much you put towards what just depends on the priority of that debt, which is based on the interest rate. So, in general, if the interest rate is less than about 6%, then I would focus more on investing. With a mortgage, I would very much hope that it's less than 6%. That goes for student loans. A lot of student loans are less than 6%. If it's less than about 6%, I would focus more on investing, because you're going to be able to make more than that per year. So let's say you have a loan that's 6% a year interest, and you invest and you're able to make 15% a year. Well, you have a net profit of 9%, right? Whereas if you don't invest and you just pay that off, you're only at 6%. Do you see what I mean? So, you can generally make more from investing. You can generally expect, depending on what you're doing, but 10% or more a year is a pretty good rate, right? Sometimes you can make a lot more, sometimes a little bit less, but 10% or so per year or more is a pretty good estimate. Mm-hmm. So if you are making, or if you have interest rate of 6% or less, I mean, it's just better to focus more on that investment, right? So, and I mean, like I said, everyone's different. Some people just really hate debt and they just want to put everything into that. But I think with this kind of stuff, it has to be logical. You can't.
But you could do both. Right?
You can do
like
both, yeah. Like, you can't be emotional about this. You can't be, oh, well, I'm in debt and I hate that, and so I'm going to focus only on that, right? I don't believe in that, because I think investing is such a powerful tool. And you can, obviously it's good to get out of debt, but the only way, I shouldn't say the only way, but the most powerful way to build wealth is through investing, right? And there are lots of other things you can do. You can do real estate, you can do, start a business, you can do all sorts of things. But the fastest way and the most reliable way generally is to invest in the stock market. And that's the best way to start out. So that's generally what I recommend. I like to do both, because it's just, I like to see that number growing too. It's fun. And it's just going to set you up better for the long run. So what percent you want to put towards what thing, that's totally up to you, and it just depends on your priorities. But, like I said, my personal view is if it's less than 6% or so, it's not a hard limit, but or so. Or generally, if you think you can make more from investing than by putting all of that towards the debt, then focus more on investing. So that's just my opinion on that. Any thoughts from you, Christine?
No.
I don't know. You might. So yeah, that's my thoughts about that.
I mean, I think it's always important to invest, and that you can't ever start too early.
Oh, yeah.
I mean, even if it's someone like me who has no clue what they're doing, which is why you have a registered investment advisor to do it for you.
Exactly.
But, I mean, you want to do it early so you can actually live and enjoy living during retirement.
Yeah.
Because, I know a lot of people who don't have much money after they retire at all.
Yeah, it's so important because...
Yeah, no, they don't, and they're living paycheck to paycheck, and that's not how it should be.
No. It's so important because it comes so quickly. I mean, I wish I would have started earlier. I wish I would have started in my 20s, early 20s. I'm still in I'm 31. I'm not even ready to say early 30s. I'm 31.
You are in your early
30s. No. I'm not ready to say early 30s. When I'm 33, I can say early 30s. Right now, I'm 31.
That's mid-30s.
No. That's 35.
I'm just kidding.
Right now, I'm 31. And...
I'm doing it just to bother you.
And... I wish I would have started earlier, but you're never going to have too much in retirement. You can never have enough. You know what I mean? So the more you can put towards it, the better. So I'm a total believer in investing every penny you can, and we can talk about that's another topic for another day. But what percent do you save per month? Of your income. I have a post about that, but we'll talk about that one of these days, I'm sure. But I'm a huge believer in that. I think that the more you can put into the market wisely, which goes really well into what we're about to talk about, the better off you'll be. So just, that's up to you how you want to split that up.
So is that the same with inheritance then? Because that was the question.
Yeah, thank you for bringing me back. So with inheritance... that's what I mean. It's like, let's say you have, I don't know, $100,000 or $50,000. I don't know how much the inheritance may be, but whatever it might be, it depends how much your mortgage is. You could do half and half, but my thing is, like I said, I would put more towards investments, and maybe pay off a bit of your mortgage. But again, with such a low interest rate, it's just not going to make much of a difference. And there are calculators out there. You can see how much you would save by paying off so much now versus waiting. I might put a bit. If it were me and I had like a good lump sum, and I had a mortgage, of like 3% or so or less, I might put like 10%, 20% into it, maybe. Probably 10%.
You like to go overboard.
I like to see.
But that's good though.
My investments growing, so I would probably use 10% for the mortgage. I would probably use like 60 or 70% for the market, and I'd probably just kind of have fun with the rest.
Yep.
Go on vacation, that kind of, and I think that's important. Have fun, but I would definitely put a lot more into the market, and you can do so much more with that. And a kind of related question, I think people talk about, okay, if I have a lump sum, should I put it all in the market at once, or should I do whatever over time? And for that, I'm also a believer in dollar cost averaging. So dollar cost averaging just means if you have a lump sum of money, instead of putting it all in at once, let's say you have like $30,000 all at once, instead of doing that, you split it up over maybe 6 months or maybe a year. So you might do, $5,000 a month or $2,500 a month for 6 months to a year versus just throwing it all at once. And that can help you, kind of average out, because if the market's going up, if it's going down, you can kind of get a better average rate than just throwing it all now, right? What if you throw it in all now and then the market drops? Yeah. As it very well may. We don't know. So I'm a big believer in dollar cost averaging. So I think that answers that question pretty well.
Yep.
So now we shall go into our main topic. Slow and steady. Not wins the race, but
come on.
It's part of the phrase. So, I had this
epiphany.
Sure.
Realization.
Sure. Go ahead. Yeah, realization. This thing that clicked into place earlier this week.
Yeah, that would be an epiphany.
Yeah, you quite. I'm in a lot of investing groups on Facebook. Some that I really shouldn't be in. It's a bad influence.
Are you still in them?
A little bit.
Okay, keep going.
And so I'm in these groups, and you see these people all the time. We've had this historic rally, as I said. And you see these people in these groups who talk about all the time, like, oh, I made $7,000 today on this one call, and I doubled my account in a week, and my goal. Okay, so there is this post. What's your goal? For investing, and someone literally said, my goal is to double my account every 6 months.
Oh, good luck with that.
And I just want to be like, what reality do you live in that you think you can make 100% return every 6 months?
Oh my God.
When really good professional traders are lucky to make 20 or 30% in a year.
And if you are doing it, share with us.
If you are doing it, well, either that or enjoy your billions, because right, like,
share your secret.
Like, what I said in that thread was, or just recently, because someone else posted this recently, if you can double your account, you'd only have to do that. Let's say you start out with like $1,000, because some people will say, oh, I doubled my account in like 2 days, right? And I started out at $100, and now I have $5,000, and blah, blah, blah. And I said, if that were true, we'd have so many more millionaires wandering around in these groups, because let's say you started at 1,000, you'd only have to double your account 10 times, only 10 times to reach $1 million. So if these people are saying, I want to double my account, and I'm doubling it every week, every month, whatever, no, you're not. You're not going to. Even if you did, it's not going to be sustainable. Right? And so the big realization I had, the big aha moment, so to speak, was when Tuesday, Wednesday, Thursday, in these groups, all these people talking, I lost $15,000, I lost $5,000, I lost 28%, someone said. And it's like, that shouldn't happen. Okay, the only way you should be losing $15,000 in a day or two is if you have a $500,000 portfolio. And I'm almost positive these people don't, right? You shouldn't be losing that much. If you are losing that much because of a pullback in the market, something's wrong. You're not, your position sizes are too big, your you're not using proper risk management, which is a topic we'll talk about in the future, but something's wrong, right? Because there's no way you should be losing $15,000 or even several $1,000s in a day or two.
Yeah, I don't get that. I don't understand that.
It happens. People get... I just heard... Okay, so there's this Chinese company, LK. Is it like Luckin Coffee? Lukin? I don't know how to pronounce it.
Ooh, it's a coffee company?
It is, but they were found to have... one of their executives, or their directors or whatever, was charged with fraud. I don't know all the details. But people are still investing in it.
Oh my god.
And a while ago, when it was really going up in price, apparently someone put like their life savings in this one stock.
Oh god.
And I mean that's I don't mean to say stupid, but that is stupid, right?
Yeah.
Right? I mean, it just is. You shouldn't be going all in. I see this all the time. I'm going all in this one thing. You shouldn't go all in anything.
No matter how good it looks.
No matter how promising you think it looks. I mean, every week or so you see this new penny stock that people are hyping up. And, you know, there was one just recently that started out like under $1 and it went up to like $10 and now everyone's saying it's going to keep going up and up and up and then crashed down to like $3. I don't even know where it is today. I don't even want to know because this whole drop, it probably went even lower. But that's what people are doing. So your focus when you're investing should not be doubling your account in 6 months. And, you know, granted, that's a lot easier to do if you're starting out with $1,000. But it's not sustainable because you're just not... Okay, if you have $100,000 or $50,000, you're not going to double that in 6 months. You're just not. Okay? Unless you have some great stroke of luck. I mean, it's just not going to happen. The thing with the markets is that the market is very efficient. And what that means is it's very hard to find a strategy that works long term and returns consistent profit. And I've done this in the past where I have this foolproof method. This is going to work. I'm going to do this and I'm going to make a lot of money off of this and it's going to be great, right? And then I try it. It might work for a couple weeks and then it fails. And it fails really hard. And the market is very efficient. It doesn't... It's hard to find a strategy that's really going to work. I mean, the way that people make a lot of money off the market, you have these high-frequency traders. They focus on profits of a few pennies, and they do that thousands of times a day. Ugh. Right? That's where people are making their profits, and that's not retail investors. You can't do that. Right? I mean, if you have over $25,000 you can day trade, then you can certainly what's called scalp, which means you just make a few dollars profit here and there, and that's great. But it's also very stressful.
Right.
I just heard something from Tasty Trade this morning. You know how much I like them.
Yes, of course.
Where they were saying like it's not. Most people just don't have it. They don't, it's really stressful.
Yep.
Right, because you're having to watch it really closely. To scalp the market consistently and make a profit, it's really hard.
And why would you? It's like, I wouldn't do that.
Right. So, I mean, if you can do that and you want to and you have the money to do that, you have the portfolio size to do that, great. But even then, it's still risk management. You don't put half your portfolio or 75% of your portfolio in that one thing. You put a few percent. Right? So... It's not about doubling your account or, you know, making a huge income off of a very small portfolio. That's not going to happen. If it has happened, you're really lucky, but it's not going to last.
Right.
Okay? It will even out. The market is efficient. It's really hard to find a strategy that works for the long term. That's why options are really useful. Like I said, with options, I said this on Monday in episode 1.
You had to think.
You know, the only other episode besides our introduction.
Yeah.
Like I said on Monday, options you can target the, you know, how likely, how probable you are to win. But even then, you're not going to always win. And the more likely you are to win, it's a risk versus reward, right? The more likely you are to win, the less profit you can get. There's no such thing as like 90% likely to win and 100% profit. That's not going to happen. It's maybe, 70% likely to win and maybe a 20% profit, right? Or whatever. So like, it's this risk versus reward. You can't have both.
No.
They're mutually exclusive. The higher the probability of success, the lower the reward. Okay, so that's just how it is, right?
Yeah.
And sometimes you can have a really low probability trade that works out really well for you, and that's great. But you have to just take it carefully. So, what I recommend doing is focusing. It's not fun. It's not as fun as saying I doubled my account in 2 days, or I made $5,000 on a $500 account or something like that. It's not nearly as fun as all that, but this is sustainable. And so what I recommend doing is, and I had to learn this the hard way, and it's not, like I said, it's not as fun, but no position in your account should have more than 2 or 3% of your portfolio. If you have a really small account, then maybe 5%. Okay? So if you have a $10,000 portfolio, nothing should be more than $200 or $300 that you're risking.
Yeah, which makes sense.
Right? And that goes for, stocks or options or whatever. Nothing should have more than about 2 or 3%, because if it fails utterly, you've only lost a couple percent. And that's fine.
Now, would you say the same thing in a bullish market instead of a bearish market?
Yeah, anytime, because bullish markets, and that's why people get overconfident, because we had this rally and people it's easy to make money in a bull market.
Yeah.
And so people were making money left, right, and center, and like any stock you picked, like I saw an article that said the average penny stock was up 80%. Now that's ridiculous.
Yeah.
Right? Penny stocks, they're risky.
Yeah.
So, any stock someone picked, it was going up. So, of course, you think, oh, I can keep doing this forever. But that doesn't last. The fun comes to an end eventually. And when it does, it's going to be a rude awakening. All right, if you have 20, 30, 40% of your portfolio invested in one position, and that one position crashes overnight, what are you going to do? Right? So no matter what the market's doing, no matter what's going on, you don't want to have more than about 2 or 3% in each position. That goes especially for options, because options are much more volatile. I did say also stocks. With stocks, though, I would focus on, you can go a little bit more than 2 or 3%, but not much. But what I would focus on with stocks is making sure that you never have more than about a 2% loss. So you might want to put in a stop loss. And again, this is a topic we'll discuss in the future as well. But with stocks, I know especially buy and hold investors, a stock rallies, and so it just kind of naturally takes on more of their portfolio as it goes up. And that's okay. But you just want to keep an eye on that and make sure it's not too big. And even then, I wouldn't ever go above like 10% for a stock that you're long on. Mm-hmm. But for options, never above 2 or 3%, maybe 5% in some circumstances for small accounts, right? Because again, if it fails, you're not going to be that hurt. If it succeeds, you'll win, you'll profit, and you can keep doing that. But you don't want to risk too much. You don't want to go all in on 1 or 2 positions. It's just, they're going to fail, and then you're going to be one of those people who lost $15,000 or 30% of their portfolio in a couple of days. Like that shouldn't happen. Like yesterday, I lost $100. Okay, because I had a variety of positions on my account. Some of them profited yesterday. Some of them failed. Some of them failed terrifically. Like, really failed. I had some stocks that I was in that went down 10%. but I didn't have all that much invested into any one of them. Right? I have enough invested that if they do well, then it'll help. And if they don't do well, it won't really hurt that much. So, that's my dog sneezing. So,
he did earlier, too.
Yeah, wasn't paying attention. So I just wouldn't risk too much. Like I said, I know that's not that fun. It's fun to risk all this money and make a huge profit and that kind of stuff, but it just doesn't really pay off in the long term. You want to be around in a year to keep doing this, and just making 100% in 6 months or 100% in a year, that's not really going to happen.
Yeah.
That's not going to happen, not long term, right? And I think my thing is it's really, really helpful to keep good records, month by month. What is your portfolio balance? What's your portfolio value? Is it growing? Is it dropping? Is it decreasing? And keep track of the rate of growth. And then you can kind of see, okay, well, I tend to make this much per year or this much per month or whatever. And you can adjust your strategy if it's not paying off that well or, whatever it might be. So I recommend keeping really good records. That's one thing I've done that really pays off, is I keep really good records. And make sure you're reasonable and realistic in your goals. You're not going to make, like I said, 100% in 6 months. I mean, again, if you were, you'd be a millionaire in no time, right?
Yeah.
And yeah, people can get rich off the market, but like I said, it's efficient. You're not going to find a strategy that pays off every single time a huge amount. It's just not going to happen. With trading, it's more small, consistent gains. So, you're looking at with options, it's easy to get like 50% gains, but a 50% gain with 2% in your portfolio is in total maybe a 1% gain for your portfolio, right? And that's not super exciting, but that's how it is. So you're looking at small gains taken consistently over time, really build up. It really does. So that's what you want, and that's you see the image for this podcast, the tortoise and the hare. That's what it's like. You can be the hare who takes a whole bunch of risks and tries to go really fast and gets set back all the time, or the tortoise who just plods along and gets to the finish line. It's not that exciting, but he got there, right? I mean, would you?
And he won.
And he won, right? He won. So you can take big risks and probably lose in the long run, because you will. Or you can be the tortoise and plod along and get there the slow, boring way, right? And, a lot of people take it like almost gambling. Because, you can go to a casino and you can be like, oh, yeah, I'm up $1,000. And then you keep going and you keep going. And pretty soon you've lost, right? And at a casino, people do it because they occasionally have big wins. But the longer you play, the more the house edge comes in and takes your profits, right? Yeah. And the house always has an edge. Now, with investing, obviously, that's not necessarily what happens. It's a good analogy, because a lot of people treat it like gambling.
Yeah.
Right? Where they won that time, so they're just going to keep winning.
That's not how it works.
And it's just not going to happen like that. So you want to have those slow, consistent, reliable gains, and it will add up really quickly.
And it does add up fast.
It does add up really quickly. It's just... And then the biggest thing is... There are several benefits. Number one, you're going to sleep better at night because you're not worried about losing all your profits or losing a ton of money. And number two, on down days, you're only going to lose a little bit, right? You're not going to lose 30% of your portfolio in a day or two. You might lose a couple percent, but you're not going to lose 10, 20, 30% all at once, right? Unless, some people, there are circumstances that are not foreseen. I'm sure in the coronavirus crash, I lost a lot. Everyone lost a lot. But some people lost so much they could not continue trading. You don't
Yeah.
want to be that person.
No. But you get upset if you lose just a little.
I do. I'm not a very good loser. When I lose money, I'm not very happy about it. That's very true. But
Just so everyone knows his secret.
yeah, I'm not great at losing. I don't like losing. I like profits. But that's why
But you don't lose much.
I don't lose much. Well, I'm very rather risk averse. I don't like a lot of risk. Now I'm in options and I'm risk averse. I know that sounds stupid, but I am kind of risk averse.
But there are ways to do it.
There are, yeah. And I will talk about options. So Monday we're going to talk about the anatomy of an option. So my goal here is, because we're going to get all sorts of people. My goal is to have material for no matter who you are, where you are on the spectrum of investing, how good you are at it or how much experience you have. So I'm going to have a lot of beginner podcast episodes for those who are just starting out, who know basically nothing or next to nothing.
People like me.
And I'll also have some more advanced stuff that will build on more as we get into all this. But Monday is kind of one of those beginner days where we're going to have what is an option and, all the elements of that. So we'll talk about that Monday. I do have, again, a post about options, but I think it'll be good just to talk about it, talk through it. And
I agree.
I wrote that post several months ago, so I think I have some better ways of describing it now, hopefully, that are clearer. So yeah, that'll be Monday, and then we'll see what's after that. But that's, options. You can do it without being too risky. It is definitely possible. But hopefully that kind of sinks in. You want to have the small, consistent, reliable gains. You want to be the tortoise. You don't want to be the hare who gets set back and ultimately loses anyway. That's just, in my experience, what works. And, when I saw those people losing the last 3 days and complaining about how they lost 30% of their portfolio, and these are the same people who gained, however much thousands of dollars when it was going well, it's like, I don't want to be on that train. I don't want to be that person, Because sometimes when... Oh, sorry. You didn't put it on vibrate.
I don't know how to put a watch on vibrate.
Oh, didn't you put a theater mode?
Yes.
Oh, oops. Anyway, sorry. So, sometimes when you see those people gaining every day, like thousands of dollars, you can kind of feel left in the dust a little bit. Like that tortoise. Like, it can be like, how can he possibly get to the finish line first? But he does, because those people who are gaining $5,000 today are going to be the same ones losing $10,000 tomorrow. It's just how it works. So, hopefully that makes sense. And despite the ringtone interruption,
I swear. I
know. I have to. Oh, I don't know. That's weird. It should have muted.
No,
too.
it doesn't for theater mode.
Well, we can always mute it too. Anyway.
Oh well.
That happened. So,
sorry, guys.
So, thanks everyone for joining. I appreciate the question, and I hope you enjoyed today's topic. And we will be back on Monday with the next episode of Possible Promise. Thanks for listening, everyone, and have a wonderful weekend.
Bye, everyone.
Bye.